The Bank of England shocked the world today when they very suddenly turned on the money printers again in order to bail out the country's pensions. Now, a day ago, everybody in the world was expecting an abrupt rate hike to fight inflation and stop the collapse of the British pound. Well, today, the British central bank did pretty much the exact opposite of that when they started printing money to buy long dated UK government bonds. What's up, guys? I'm nobody special, and I want to give you a disclaimer. There's going to be a lot of terms and phrases that you've probably never heard of before in this video, but I promise you this stuff is not that hard to understand. It's just going to be a lot of new terms. And by the way, if you do make it through this entire video, congratulations to you for investing the time to actually understand what's going on and inform yourself rather than just buying some political talking points prepared for you by journalists who know nothing about this subject matter and will just spoon feed most of the public pre-existing political talking points. But first, we got to shrink my big melon of a head and get to the story. Here we go in Bloomberg, dated this morning. BOE steps back into bond market to restore stability. That is long speak for they are printing money again. 30-year yields set for the biggest fall on record after the statement, and officials warned of risk to stability if dysfunction continued. The Bank of England staged a dramatic intervention to stave off an imminent crash in the gilt market by pledging unlimited purchases of long-dated bonds. All right, right there's your first term that maybe you've never heard before. A gilt is a term for a long-term duration government bond in the UK. Basically the equivalent of a 30-year US Treasury over in England. They refer to it as a gilt. With the fallout from the government tax-cutting plan still ripping through UK asset prices, the central bank had been warned that collateral calls on Wednesday afternoon could force investors to dump government bonds, triggering a major crash, according to a person familiar with the bank's decision-making. The plan is to buy longer-dated bonds in daily tranches of up to £5 billion, which is about $5.3 billion, and it had the immediate effect on the gilt market, putting yields on 30-year debt on track for its biggest drop on record. They had earlier climbed to the highest level since 1998. And here you can see what that looks like. This is a chart of the yield on the UK 30-year gilt. And you can see it started this big run-up on Friday of last week after the back-to-back announcements of the UK's latest energy bailouts, and then this sudden tax-cutting plan unveiled by their Tory government. Now, of course, the leftist global press and the elitists that run things in Europe are hyper-focused on this tax cut plan, but honestly, I think it has way more to do with the energy situation, something I'll address in a future video. But suffice it to say, since those back-to-back announcements, the yields on these longer-dated UK treasuries started to rise, and they entered into this feedback loop that caused them to spike, and it almost caused something to break in debt markets. The Bank of England turned the money printers back on, made the announcement, and then, of course, the yields very abruptly fell right back down. So this energy crisis morphed into a currency crisis, and now, as predicted, it's become a banking crisis. Although it's a slightly different mechanism than I predicted in my video earlier this week, it's actually starting in the pension system. Now, one of the phrases you're going to hear thrown around a lot in the next few days is something called LDI, or liability-driven investment. Now, LDI is an investment strategy that's used all over the world, including here in the US. And it's a strategy where they manage the funds so that the performance of the funding somewhat matches the changes in the liabilities of the fund, i.e. the expenses that the funds have to pay out. If something happens where people's living expenses would rise in the future, the fund is designed so that the fund's performance would increase to match that rise, and vice versa. So liability-driven investment is really just a strategy that pension funds use. Now, there's one particular aspect of this LDI strategy that's causing all this problem, and that's the use of something called interest rate swaps. Interest rate swaps is supposed to be one of the ways that these funds manage their exposure to changes in interest rates and how it would affect their expenses to their pensioners. And it works a little bit like this. Say that pension fund holds an asset, and that asset has a fixed interest rate, like a government bond. And then you have an investment bank on the other side, and they hold an asset that has a floating interest rate. In other words, the interest rate goes up or down over time depending on market conditions. So these two parties, the pension and the investment bank, enter into what's called a swap agreement, where they basically exchange the interest rates between the two assets. Now, when they swap these interest rates, they make the agreement to each other that they will pay each other the interest on those two assets. So now you have the pension fund that has promised to pay the investment bank an adjustable rate interest, and the investment bank has promised to pay the pension fund a fixed rate interest. Now, at the time this agreement is made, there is no value whatsoever on either side of this trade. It has a net zero value when the swap is made. There's a few dollars in fees, but no actual money changes hands. Actually, no actual assets change hands. The pension and the investment bank don't actually go out and buy the underlying assets. They just promise each other to pay the interest rates on those underlying assets. So that's an important thing to remember, that at the moment the agreement is signed, almost no money changes hands. Now, for the pension fund, this actually works out really well as long as interest rates are falling, which they have been doing for the better part of the last 40 years. Because remember, the pension is paying the adjustable rate interest, but they're being paid the fixed rate interest. Well, the fixed rate interest was decided when interest rates were higher. Now that rates have gone down, the pension fund is paying less than they're being paid. So that swap has become an asset to the pension fund, and it's become a liability to the investment bank. And these rate swaps is one of the reasons why all the pension fund managers around the world a year ago were patting themselves on the back and congratulating each other on doing such an excellent job managing their retirees' money, because these rate swaps for the pensions had gone up in value significantly because interest rates have been falling pretty much for 40 years, especially after the unfortunate health scenario that happened in 2020. In fact, it was working out for the pensions so well that it appeared at the end of last year their biggest problem was how do they fight climate change, not how do they guarantee their clients money. Well, that worked out really well right up until about January 1st of this year. And very abruptly on January 1st, interest rates stopped falling and they started rising, and they've been rising pretty much all year long. Now that trend is reversed. Remember, the pension is paying the adjustable rate and being paid the fixed rate. So in a rising interest rate environment, now the pension is starting to lose money. They're paying more than they're getting paid. So now that swap is actually a liability for the pension, and it's an asset for the investment bank. Are you still with me? Good. Now, by itself, this doesn't seem like such a big problem, but there's a couple of other factors in play here. Number one is leverage. These are not one-for-one swaps. Some of these swaps have multipliers attached to them, where you actually have to pay as much as 7 times the difference in the interest rates. So if the change between the fixed rate and the adjustable rate is 1%, well, you have to pay 7% to the other party. So once you factor in leverage, now this is becoming a much bigger liability for the pension funds. Another thing you have to factor in about these swaps is their unfunded liabilities. They don't actually go out and buy the underlying bonds. They just make the agreement to pay each other the two rates. In other words, their debt, their IOUs, their credit, their only promises to pay each other these interest rates. So in order to guarantee that promise, the pension fund will put up collateral, something that the bank could seize or sell if the pension fund was unable to pay. So if the interest rate on the adjustable rate that the investment bank is holding rises high enough, that's when the investment bank calls up the pension fund and says, hey, you're way underwater on this trade. We're starting to worry that you can't pay us, so you better put more cash in your account. Otherwise, we're going to sell your collateral. That's called a margin call. And that's what started to happen this week when we got this spike in borrowing costs in the UK following the twin announcements of the energy bailouts and the tax cuts. So now the pension funds are getting margin called by the investment banks. The investment banks are saying, you owe us too much money. We want you to put more cash in your account. So where are the pensions going to get cash from? Well, they're going to have to sell some of their assets. And what is the most common asset that's held by UK pension funds? Well, it just happens to be UK government debt, aka the same gilts that they have these rate swaps on. So when the pension fund gets the margin call and they say you have to put more cash in your account, they go and sell their long-term UK government debt. Well, what happens when you sell UK government debt? You drive down the price of that bond, and when you drive bond prices down, you drive interest rates higher. And that's when this turned into a feedback loop, because remember, the pension funds are on the hook for any increases in the interest rates on those bonds, sometimes 7 times as much. So when all the pension funds get the same margin call on the same day, and they all start selling the same thing, driving down the value of that thing and increasing the interest rate on it, thus increasing the rate of margin calls, now you've got what's known as a doom loop or a feedback loop. And check out this description in Sky News. Pension funds would have collapsed today without BOE action with mass insolvency. The Bank of England's intervention announced today was in response to a run dynamic On pension funds, Sky News economic editor Ed Conway has been told it was a bank run, folks. If the bank had not intervened, there would have been mass insolvencies of pension funds by this afternoon. It's very similar in kind of wholesale terms to what we saw with Northern Rock when there was that run on the bank back in 2007. It's a vicious cycle, essentially people trying to withdraw money, which in turn sometimes leads inevitably to financial collapse. I'm told that there were a swath of pension funds that, were it not for the government's intervention, would have essentially collapsed by this afternoon. That's how fast moving this crisis in the pension markets was. And it becomes self-sustaining, and that's when the Bank of England decided they had to intervene. They said, we need to print as many pounds as necessary to start buying up these gilts in order to drive their values back up, drive their interest rates back down to stop this wave of margin calls that's bankrupting our pensions. So on the surface, this looks like the Central Bank of England bailed out the country's pension funds. And to an extent, that is what they did. But keep in mind, those swaps, they're actually a liability for the pension funds. They're an asset for the investment banks. Now, the swaps that those investment banks are holding are actually very valuable right now. The investment banks are making money hand over fist by the bankrupting of these pension funds. Now, if the pension funds were to fail, if they were to default on those swaps, then that asset that's on the books over at the banks would go to zero. That's known as counterparty risk. When the people who owe you money can't pay, you lose. And as it said, when you owe the bank $1 million, you have a problem. But when you owe the bank $1 billion, the bank has a problem. So really, when you think about what the Central Bank of England did today, they didn't bail out the pension funds, although that's the story being sold to people. They bailed out the investment banks. That's who ultimately benefited today, because without the actions of that central bank, all the rate swaps that are being held as assets on the balance sheets of those investment banks would have gone to zero, along with the value of everybody's pension in the UK. So what does this mean in the long run? Well, folks, it's not that hard to imagine what happens when central banks start printing money again when they already have 10% inflation. This is only going to make inflation in the UK worse. And keep in mind, we're just heading into winter, where the central banks are going to try to print their way out of a molecule crisis. No matter how much money you print, you can't make more natural gas appear. Inflation is coming to Europe in a big way this winter. And if you live in that part of the world, you need to get ready, folks. We've been talking about this for months. We didn't exactly predict this pension mechanism as the mode of failure, but we have been talking about how this energy crisis is very quickly going to become a banking crisis. Namely, we've been talking about that economic death triangle in Europe, when you have price controls and you have bailouts and you have total inaction on energy supply. You have a recipe for infinite prices for energy, infinite money printing, and ultimately hyperinflation. And that is what has just started in the UK today. And if you want to know a little bit more about that, you can check out this video I made about Europe's economic death triangle. Till next time, live small and dream big.